So we want to give you a couple pieces of information so you can feel okay about your hard-earned assets that are sitting in the U.S. financial markets. Unbelievable. I think it was like $72 billion in market capitalization of stockholders that held stock with Silicon Valley Bank. And that money's gone, never to come back. Now the depositors are going to get their money back. The $220 billion of deposit money, those folks can get their money back. But I mean, imagine if you were a retiree in Santa Clara and you were 80 years old and you were standing in line like so many people were at a Silicon Valley branch in Santa Clara, California, and you're sitting there hoping that you can withdraw some of your life savings. How scary would that be? And what I would encourage you to do is to diversify your risk, invest in a 100% financial reserve product like a fixed index annuity versus a 10% financial reserve product. How scary has it been for Silicon Valley Bank depositors this past week? And if it weren't for the U.S. government stepping in to do a bailout, and that's what it is, the people that had over $250,000 in that bank would have lost those additional dollars. Number one is U.S. banks have $620 billion in unrealized losses because of mainly of the bond exposure they have with government bonds. As interest rates have gone up, you have interest rate risk with bonds. So you got to be very careful. The chairman of the FDIC warned that these unrealized losses weaken a bank's ability to meet unexpected liquidity needs and cautioned that mapping out a strategy to fund themselves profitably would prove a complex and challenging task.